Christmas Day, you needed 21,000 in your margin account to hold 5,000 ounce silver contract. Silver was $60 roughly on Christmas Day. The next day, they raised it by 30%. If you don't pay, we're going to unwind and liquidate your account. So now you have to put $47,000 in your margin account. $27,000 in your margin account. The reason I said 47 is today it's $45,000 an ounce to control 5,000 ounces. A company like mine will have 2 million ounces of silver at any given time. If it costs $45,000 to hedge my exposure, meaning the margin account means I short 2 million ounces on paper, on COMEX. I have 2 million here, I short. If the price falls by $10 an ounce, I'm down $20 million. I'm out of business. But what I sold short goes up by the exact same amount. But in order to maintain that position, I have to have $47,000 per 5,000 ounces. You have to have millions. That's before the gold, 35 or 36,000 for one 100-ounce gold contract. Well, what that does to the speculators, the people who might be very wealthy, but they're not wealthy like sovereign central banks, sovereign wealth funds, Tesla, Samsung, Sony, who don't play on margin. These people get shook, and all of a sudden they have to sell to cover the margin requirement. Maybe they have 50 contracts, and they have 20 million in their margin account. And all of a sudden the price jacks way up on margin, and the price of silver is moving up $7 on Friday. It's up right now, and just as the market opened in Asia, it's up $3. They're going to get margin called again. So they sell. The weak hands sell. They're forced to. And what happens? The big money who is not on margin comes in and says, yeah, we'll take, we'll take the 50 million ounces of silver. Every single month for the last 15 or 16 months, between, 30 and 50 million ounces of silver are standing for delivery every single month. And ask yourself, who the hell is doing that? And where's the mainstream talking about this? Why do I have to scream about it every single podcast I do? This is so far unusual. It's 4 feet of snow in Death Valley in July. It doesn't happen. And all I can tell you is that that's all people need to know, because these are the most well-informed traders on the planet who are literally standing for delivery for billions upon billions upon billions upon billions of gold and silver. Don't tell the public. Who the hell is standing for delivery every single month on COMEX? Every month for billions of dollars worth, billions upon billions upon, in December. It was the largest delivery in the history of the COMEX market for silver for a December contract, like 65 million ounces. So far in January, which is not a primary delivery month, we're over 40 million. So in the last 40 days, we've seen, 120 million ounces nearly stand for delivery. Who's doing that? A mint box of Silver Eagles is 42 pounds, 500 ounces. Who's buying 110 million ounces? And I think when you understand this, when you look at the deliveries off of the LBMA and the massive deliveries off of COMEX, what I would say to you is that the most well-funded, but more importantly, Charlotte, the most well-informed. People at that level don't do this for the hell of it, right? If you're dropping billions and billions, do you not think you know where it's going? Are you not really connected to the inside when you're spending that kind of money? And I would argue it's not a one-off. It's been every month since Trump won the election. And then what do you know? Silver is now a critical mineral, as now reclassified by the government. And what do you know? They just said, we will put state-sponsored price floors underneath all critical minerals within the next 90 days. That was a law that was just passed last week. That is to incentivize domestic mining of all of these critical minerals, because, prices are where they are. If there isn't a floor at a high enough level, you can't incentivize domestic mining for things that are becoming harder to find. And then they just came out and said, now there is a proposal in front of the House and Senate. It's cleared one of the chambers. I think the House has to now pass the Senate, saying we need to build a strategic stockpile of all of these minerals. What you are seeing is not two brothers in 1980, the Hunt brothers, trying to corner a market where, same environment, they see way more paper than bars, and they're supposed to be one-to-one. Well, wait, if I buy all these paper contracts, but there's not as many bars back there, well, what if we stand for delivery? What happens? Price goes way up. Well, the exchange changed the rules on the Hunt brothers. They said you can't be that long, but you can be short as much as you want. They had to sell the contracts. 2011, it was about leverage and the leverage, that speculation. So what did they do? They raised margins a bunch of times. And if you raise margins on the COMEX, meaning you have to have more in a margin account than you did the day before, they keep raising until the people who are on margin are forced to sell, which drops the price, which begets more selling, and the price collapses. Didn't come back for 15 years. On Christmas Day, about a week before this year, they raised margins. Case in point, TD Bank, who's very short in the overall scheme of things in London and on COMEX, and they came out 3 weeks ago and sent a letter to all their investors saying, we believe silver's devilish blow off top, always framed in a negative connotation, has reached its peak and is heading towards $40, told everyone to short. We are going largely short, they say. We believe silver's heading to $40. They got stopped out last Friday at $92 at a huge loss to them. And these things, raising margins, rhetoric, negative rhetoric, telling everyone we're going short, lease rates expanding, none of this stuff, which always would have crippled the market as it did in 2011, it's not working now. And prices are just running. And people who have been ridiculed by friends and family, by financial advisors, what the hell do you want that stuff for? It doesn't pay interest, they say. Why would you buy that? Are finally being vindicated. And it's a lonely feeling, Charlotte. The people who come here like to talk because they finally have people around them who understand that they're like-minded and get it, and they can have real conversations. Whereas I go into Thanksgiving dinner, my wife says, don't you dare say a word as we're walking in the door, not one word, because I want to stay through dessert. She'll say to me, I'm okay, I won't say a word. But the point is, the public hasn't received the message. The people who have been here year over year have invested accordingly and have felt isolated, alone, wondering if they made the right decision, and to see what's happening now, which is a function of mathematics and logic, which always seem to work out over time. You can't hide from Mother Nature, nor can you hide from mathematics. You can run and you can inject variables and you can do all you can to evade, but just like Father Time, it catches us all, as does mathematics, as does Mother Nature. And it's really heavy to see the people here, I mean, some of them in tears, saying my life has been changed forever. It's very heavy. Like, I invested $300,000, a lady said, I was just telling you downstairs, she said, I flew here to meet you. In tears, couldn't speak, like she couldn't speak. And she said, I flew here to say thank you to you, that I'm a millionaire now since May, and I put my life savings in because I listened to you. Of course, it's being better than chased with pitchforks, but I will tell you, it's very surreal. I've done this for 36 years. I've been coming to these conferences for half that time. Not only is the amount of people here exponentially greater, but the vibe is surreal. And you know what? I just want to say to people, in a market that's moved as fast as this has, short-term caution is always prudent, right? Nothing goes straight up without taking a breather, but you can still coexist, that can coexist with long-term bullishness. And I am hugely long-term bullishness, but yeah, anytime things move to this level, got to be careful. But I'll tell you, to your question, it's so far different than anything I've ever seen. It's absolutely off the charts, and it's very surreal.
Yeah, it's definitely a really interesting mood here. And I want to talk a little bit more about that repricing angle when it comes to silver.
Yeah, I mean, well, it's being repriced in the respect that you're finally finding equilibrium between real supply and demand. Unfortunately, the market has been controlled by paper derivatives, where the ability of the Western banks, 8 of them in silver, 8, one or two in Canada, 3 or 4, 2 or 3 in Europe, and 5 or so in the United States, have maintained the largest concentrated short position of any commodity ever traded in the 1,000+ commodities on COMEX ever. Let me say that again. The largest concentrated short position of any commodity ever traded on COMEX. Why? Why? And to me, that's the first question. And the answer is, in my mind, because of the military-industrial complex. The West has ruled the world through strong military. The amount of silver needed in high-tech weaponry, from cruise missiles to F-35s to stealth bombers to submarines, nuclear submarines, all this stuff, and these really, really high-tech weapons now that are going Mach 3, Mach 5, whatever they are, the hypersonic missiles, the heat that is generated in the cone of the missiles is so extraordinary, the only thing that works is silver. And the military-industrial complex doesn't care about the price, right? Because if you need 500 ounces in a high-tech weapon, cruise missile that sells for $20 million. What the hell do you care what the price is? It's more along the lines of the rest of the world understanding how important and vital it is in everything, not just military, digital, electronics, you name it, let alone the monetary aspect of it. I've been coming to Vancouver for conferences for a very long time. And before I came to this one, I would come to the Agora conference, which became the Rule Symposium, which now has moved to Boca. But the Agora conference back here was a decade plus ago, and I would get up on stage, and I've always been way early. People probably think I'm full of crap for saying it, and that is that this market will be defined in two ways, and I'm proving to be right, I believe. One, it will be too expensive for most people. They'll say, geez, it's so expensive, I missed it. But for people watching this show, it will be more about the difficulty obtaining product reasonably and with any expediency whatsoever, because there's very little product out there in relation to the total amount of money out there. And we are the pimple on the elephant's rear end. The elephant has no idea, but we've been talking about it forever, so we think there's plenty of it out there, right? As Rick Rule, who was in here, I saw 2 interviews before me, he will tell you 0.5% allocation from precious metals and precious metals equities across the entire financial matrix from Joe and Jane Sixpack, as he always says, to the Harvard Endowment Fund. Well, guess what? The Harvard Endowment Fund just bought a couple $100 million in gold. When the public wakes up, it will be either too expensive or too hard to get the product. And I think that is how the market will be identified on a large scale. So it is a fair question. There's not enough to go around. And if that moved just to 5%, if Rick is right, that's a 10-fold increase in demand, Charlotte. How about 10%? And you know what's interesting? Wall Street never acquiesced to metals. And you get an advisor and say, fine, 5%, put 5% in. Well, the chief investment officer of Morgan Stanley just came out and said, Wall Street has used a 60-40 rule for the last 50 years. 60% stock, 40% bonds, retire wealthy. Okay, well, he said, listen, half of that portfolio is broken. Sell half your bonds and put it into metals. He's saying 60-20-20. Michael Hartnett, the chief analyst for Bank of America, who has a very, very expensive newsletter that goes to the institutionals, he says, no, 25%. Jeffrey Gundlach, the bond king, who's made his life selling bonds, said, no, 25% is not overweight. So if 5% would be a 10-fold increase, how about listening to the chief investment officer of one of the biggest banks in the world, Morgan Stanley, who says 20, or Michael Hartnett 25, or Jeffrey Gundlach says that's undervalued, or not overvalued, not overweighted. There'll be nothing left overnight. And I say that I don't care if people think I'm talking my book. At this stage, after 36 years, I don't need to talk my book. And all the interviews I do in my own YouTube channel, I'm not going to destroy my name, that of my family, and my company's name by saying anything that I don't believe in my soul. In China, Shanghai is offering $12 an ounce more, thereabouts, per ounce than silver. For silver than we see it in the West. So if you're a trader, you can, if I give them 10 million ounces of silver, buy paper here and deliver it in Shanghai, well, that's $120 million. Done. That's what they're doing. And that arbitrage is that sucking sound, if you listen, that's their way of saying, be dumb enough, please. We're sitting on all of your dollars through the trade imbalance. Please be dumb enough to give us your silver, and we'll pay you handsomely for it in your dollars that have the retaining value of a melting ice cube, where they're continuously losing value through irresponsible fiscal policy. And so you have, for example, China right now is expanding their Shanghai Metals Exchange throughout the entire Belt Road Initiative, using local currencies, all these nations trading over Enbridge or SIPS, the Cross Interbank Payment System, both of which are not compatible with SWIFT, and they're settling imbalances in gold. Now think about this. China just signed up the ASEAN nations. These are the countries in Southeast Asia who represent China's largest trading partner by far. There's 800 million people there, twice the population of the US, 30+% of GDP. They're now signed up to SIPS and Enbridge, which means all of the trading won't go through SWIFT. It'll go over other channels that SWIFT isn't compatible with in their local currencies. And imbalances are settled in gold. In other words, instead of when it had to be dollars, well, that supports the dollar strength, right? And when you have all these dollars to conduct trade, you put the reserves, instead of leaving them earning nothing, you put them into treasuries, which are very liquid, which give you a return. So that supported and kept rates low and kept asset prices high, right, in the U.S. So what if they say, well, we don't need dollars anymore. We trade our own currency, building our monetary system instead of that of the United States. Better be smart about it. And then instead of holding treasuries to put reserves in, we put it into gold, which has doubled the performance of the treasury for 25 years. Look at the last two. 2024, gold was up 40%, the dollar or the 10-year treasury up 4.5%. Last year, 10-year treasury up 4, gold up 80. The point of it is that it can't be weaponized, can't be taken from you. It's outperforming it, has no counterparty liability, and these countries have had it with the U.S. and our monetary policy being at the end of the barrel of a gun.